Good afternoon and good evening. Welcome to Traders Workshop for Tuesday, April 25th. I'm your host, Tom Schneider, CMT with NinjaTrader. Before we get into the good stuff, I do want to remind everybody, futures and options trading contains substantial risk, is not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose. Doesn't keep you up at night, doesn't extend your retirement horizon. I also want to remind everybody that past performance is not necessarily indicative of future results. It's very important. Also, what we talk about here in this program contains neither trade recommendations nor financial advice, but should only be used for educational purposes. And with that out of the way, it's my pleasure to welcome back to Traders Workshop, Jim Marzano from Metrics. How you doing, Jim?
Doing great.
Awesome. So, last time we talked, I think it was a little bit cold, a little bit snowy, maybe inclement weather in Chicago. You look tan and rested, Jim.
I did get down south for a little while, but today I'm actually out overlooking Lake Tahoe. I wish I could turn my screen around, but it's absolutely beautiful out here and still record snow. It's amazing. The ski lifts are all packed out here at the end of April. It's amazing. They're also trying to
Wow.
figure out where all this is going to run off to. So lots going on, but just a beautiful, beautiful setting.
Right. And from my perch here in Long Island, we've had such a mild winter. It's just amazing to hear when places like Texas, Nevada, all these places are getting snow still. It boggles the mind.
Yeah, yeah. I flew out Saturday from Chicago and they had to de-ice the plane. All of a sudden, the snow came in. So it's
Yeah,
crazy,
right.
crazy stuff.
So you're having fun in Lake Tahoe. We connected again, and you were telling me about some new stuff. We'll get to that. But for those of you viewers, by the way, before I go on, Jim, I do want to remind everybody that NinjaTrader.com/learn is where the chat resides. So if you want to ask Jim some questions, we're going to be talking about some pretty interesting data here and Jim's take as many years in the trading markets on the data. So if you have questions, you can go to NinjaTrader.com/learn. If you don't have an account, you can sign up. All you need is an email address, sign up, and then join the chat. Feel free to drop in questions for Jim as this conversation progresses. But for those of you, for those of the viewers who haven't seen you, Jim, can you just give a little bit of background on how you got into the financial markets, and what your experience has been to get to metrics?
So my entrance into the business a long time ago came in through the Board of Trade, and it was the context of markets in this country and certainly globally. In those days started with grain. There just wasn't a lot of other things trading. And then in the early 70s, we started to add other, quote, commodities, physical products that would benefit from the pricing, price discovery, and certainly potential to understand the analytic aspects. What am I buying? What am I selling? And all that stuff kind of puts into context that where we are today actually isn't that old in the scheme of things. And the overall statistics, when I started, the Board of Trade did well over half of all the commodity business globally, which takes in, obviously, all the grains. We did have a plywood contract. We had a lumber contract. We had silver, which was okay. But it wasn't until 73 that Americans were allowed to own gold, oddly enough. And so in 1973, they started a gold contract on the Board of Trade. And actually, a year earlier, the Mercantile Exchange had started to trade foreign currencies. And this was kind of the whole beginning of a new era where the fundamental idea is, can we trade money in any kind of a form, whether it's a currency, whether it's gold, which has obviously a currency value to it, or later on, a few years down the road, could we actually trade paper items, not a physical commodity? And that's really where I started, and that was in mortgage futures. And all the machinations of an industry came together. Competitors got to be complementary forces. And the issue was we wanted to trade this mortgage future based on a security, because then we had an item that would be not only fungible, but would have the surety that you'd have delivery. those two things are really critical for any market. And if you look at what's happened today and into interest rate swaps and softwares and all kinds of things, those elements are still there. So the fascinating part, you got two regulators together. At the time, the CFTC, Commodity Futures Trading Commission, had just really started. Most of the stuff we wrote for those contracts was under the old Commodity Exchange Authority, which came out of the 30s. And was a much different animal, obviously, all grain-based or agricultural or, again, physical product. And in the mid-70s, the SEC and the CFTC got together with what was called the Shad-Johnson Accord, which allowed the Board of Trade to trade these mortgage futures in a commodity market. And, of course, the whole idea was that the commodities given, you've got a lot of leverage, you've got margin, you've got clearing, you've got all of the elements in place that a securities company did not have. And I think the behind the scenes answer was the New York Stock Exchange was not going to invest in it. So they didn't want to tool up. We welcomed it open arms. And, in a few words, the rest is kind of history. So the mortgage future opened in 75. In 77, we opened the 30-year Treasury, which is still around today. And at the time, those two contracts really propelled the Board of Trade and now the Mercantile Exchange owning all these different exchanges to where they are today. So fast forward, if you can, when I said the Board of Trade did half the business in the world, the combined exchanges of the Chicago Mercantile Exchange are probably over 80% of all the business in the world. The volume is incalculable in terms of a multiplier. It's 100 times, 500 times. It depends on what's going on. But if you look at the market cap now of the Mercantile Exchange, from those raw ideas, can we trade money as a commodity? I think their market cap is bigger than all the U.S. automakers combined. So it was an idea whose time had come.
Jim, I have a quick question. I'm going to break in real quick. Not knowing this with the mortgage futures, why were mortgage futures chosen, if you will, before Treasury futures? I would expect something like sovereign debt to be kind of the base where everything else springs from.
Well, it's interesting. It's a good question. Sorry, Tom.
No, go ahead.
It's a great question. They kind of in reverse order. The sovereign debt, really, we started to trade as other exchanges globally got the idea this could be a really magnificent volume generator and obviously revenue generator. But you had constituencies in all different parts of the world. So the Japanese, they want their JGB traded in Japan. The Brits want the gilt there, the Deutschmarks, etc. All of the bunds, let's stay in Germany or later on in the EU. And so exchanges popped up and they were trading. Most of them started with their own sovereign debt. The other problem was just a simple one that our traders want to go home at 2 o'clock and they didn't want to stick around and start trading till midnight, which, this is long before we had electronic capability. Oddly enough, we started a night session on the Board of Trade, which lasted, I think, for a couple of years, and an early morning session so that we could roll out ARBs, when you'd have both exchanges open on the idea that would work. Actually, going back to mortgage futures, the Amex, the American Stock Exchange, opened up a commodity division and traded a mortgage future. The problem was they never got, the penetration. So now we had, one of the first real wrinkles in the whole process because people were stuck. You'd have to liquidate one to get the other. You can't find liquidity. Everybody's trying to get out. And so that was ended up as a negotiated situation. But other than that, we would have preferred the Treasury. But I think this Shad-Johnson Accord was a pretty big stretch. We also had the support, Richard Sander, was head of economics at the Board of Trade, the doc, and he had written a thesis based on mortgage futures. And so to get this in without spending another year or more, trying to study which would go, mortgage futures were there. The other point, the mortgage future was based on the Government National Mortgage Association contract, or GNMA, or fondly Ginnie Mae. And the point was that all the mortgage bankers in the country had gotten now where they could originate their own, Tom's mortgage and Jim's mortgage and et cetera, into this security. And then the security was basically became the traded item. And it really added kind of not only surety, but it became a uniform pricing mechanism. So that whole piece was, really one of the reasons they started with that. But as time went on, after literally less than 2 years, we knew if we could get a U.S. Treasury government bond, we could really do something with. To say nothing of the fact that all the mortgages at some stage are really priced off, probably at that stage, a little longer than the 10-year. And so as we got to the 30-year, and then we were able to get the 10, the 5, the 2, Fed funds, even a municipal bond contract that I chaired for a while. So, the progression is still, really good. What's happened with the advances in the markets is these are, this is how the world basically prices interest rate risk, exposure, et cetera, is off a futures contract. Still pretty novel idea.
So you mentioned you chaired the what was it, the municipal bond futures. So that was kind of, you've established the mortgage future, you then come along the treasury futures. Now you've got municipal futures. Then what happens in your career? It seems like you've seen this. You've matured along with the market, right? This particular part of the market.
So I kind of moved into. I was working with customers most of that time. That would, my role was to help them understand how to apply hedging techniques. I got into valuation of items that, if the vanilla item, if you will, is the 30-year treasury, everybody understands that. And you're trying to hedge, let's say, a municipal bond off that, even though its yield and maturity, et cetera, you configure the duration, the convexity of the bond. You get into some fairly esoteric differences, which, now the hedge is maybe not as good as you thought to begin with. And what I found, and this is now into the early 90s, was the pricing mechanisms for the cash side of the market. In other words, we worked with insurance companies and pension funds that had municipal bonds and said, how do we hedge that against the future? How do we manage our risk? And that's really why exchanges exist. But those hedges and those differences or those basis calculations were never solid the further you got away from a very standardized or well accepted, like a government. There's nothing better than the U.S. government treasury. We hedged foreign debt off that, but there would be times in economic cycles when those relationships would just explode. The best example of it wasn't in the bond market or the interest rates, was actually in oil just a few years ago, when there was a complete lack of buying for the current certificate. So you actually went to a negative basis of the cash market. So these kinds of things, always cause more study. And then you say, well, how do we move the information around? And that's kind of where I came in and built some systems that were aggregating data from the back office, so we could understand how much they were making or losing, but also all the analytics. And that, long story shorter, led me to develop metrics and now bringing in other content like social media data.
And when you mentioned, just for point of reference, the negative price in oil, that was what, 3 years ago?
I think about 3 years ago, yeah.
Yeah, right around COVID hits, and then the supply chain kind of locks everything up. And where do we put the oil? Yeah. Oil goes negative. Okay. Okay. Just wanted for a point of reference. That's, we're talking about a long timeline, but that wasn't too long ago. That was 3 years ago. And when you mentioned systems, we're talking about data systems, not necessarily trading systems. I just want to point that out because we have some viewers talking about trading systems.
It was all data. It's data / analytics, but it was all purposeful or purpose built to very specific contracts, or in the case of like the back office, the commercial interest in every futures market and actually every securities market uses multiple brokers. And we solved a very simple problem where a large pension fund at the time, I think, had 12 different brokers. And so we filled one big requirement, that is, we consolidated all of they were large futures traders, back office data, so they could get one margin call across the book, with a book in it, and they were fixed income hedgers. So when I was mentioning the sovereigns, they had bunds, they had gilts, they had just about everything anywhere they had a relationship, or in their case, a plant. And so solving that, and it was more a housekeeping thing, but it helped them to understand how they could reallocate some of those hedges just based on the fact that maybe they were paying double margins, or maybe margins got high. And what most hedgers do is at some point they roll out of the futures market into an instrument they can just portfolio. We also then use that information to help understand what the cost of the swaps were. And that's really where we did a lot of work, going into the 2000s. So it's, but it all comes back to the futures market and basis. Again, if you're in a hedging role, whether you're a farmer trying to figure out the relationship between what you're going to pay for or get the bid you're going to get for your corn at the local elevator versus the Board of Trade corn contract. And all those calculations are obviously real time and continuous.
And you consolidated them for your clients where they were getting in different prices or different contracts, different brokers. You're basically, I wouldn't say normalized, but you put them all in the same place where they could be equally
aggregated,
analyzed.
Right?
Yeah, aggregated data,
totaled, and then allowed. What's the kind of common piece to where we are today? We used Excel as our front end, and so we just distributed. I think at the high point we probably had about 600 users with very highly confidential data delivered every morning on a spreadsheet. We've now moved that over to Google, so the data we deliver today comes in a Google sheet, which has got flexibility. It also addresses the problem. We're not educating people on trying to or force them into a specific, GUI. Everyone understands usually the spreadsheet, and if they update continuously, it's a heck of a resource for doing your job every day.
Yeah, and that efficiency, that ability to make people more efficient is worth its weight in gold, no pun intended. I'm sure a lot of time was spent before your service came in and you came in to aggregate all that data. A lot of time was spent trying to figure that out. Even maybe they couldn't figure it out, right? Maybe they just worked the way they worked and you came in and made it easier.
Well, what the role that we filled was basically kind of the independent intermediary. So from obviously commercial and standard business practice, broker A does not want to share his data with broker B if they have the same client, and now you're up to a dozen of those. So that once we built the pipelines and we build all of the math and intellectual property behind it to convert, broker A may use a decimal, broker B may use a fraction, broker C may use a combination. Then there's different time zones. When is the data available? All that sort of thing. So we just normalized, if you will, the traffic between the FSAM community and large hedgers. So that worked out to be a good business, tedious, but it filled a niche. And then again, what we did and what the customers did is we moved that data into other applications. And actually, that's a great kind of segue into what we're doing today.
Yeah, Jason, maybe we can show the screen, Jim's screen.
There we go.
So, Jim, if you want to explain kind of what metrics is and what you do. So this is present day, right?
We've rolled right up to present day. And what I thought I'd do too before we kind of get too much into this is look over again, and in my history, and I think everybody that's traded, remember whatever day you walked in the door, so to speak, if you look at what you were doing in terms of data analysis, the data that you were able to secure, the cost of the data, and then what did you do once you kind of got used to it? And we can go back. Some of these terms may or may not be familiar, but point and figure. I've still got a friend that does point and figure charts. We were doing point and figure charts. I don't want to tell you how many years ago, but graph paper became in high demand for a while, and it was a great method. But it's outgrown. I don't know if anybody really does it. I've seen it automated. It looks good, but in any effort where you're trying to analyze what's going on in a quote time series of different prices, you need to understand how the tool works. And then you have to understand how you're interpreting what the output is. So there's always that kind of, first of all, can I organize it? Can I put it in a form that I can, use it repetitively? And then what am I going to do? What's my intellectual property or intellectual process, I should say, to take that data and make a trade with it? And at the end of the day, those are the two things you have to do. So everyone's on their own from an analytical perspective, no matter how, generic the data. And it's all going to come down, do you make a buy, do you make a sell? And if you do you place a stop? All the things that, are kind of normal in trading or investing. The next part over years became very popular was candlestick trading. And candlesticks have been around, I think, since Lord knows when in Japan, mid 1400s, some say. And the wick and the length of the shadow, all those things, and then some of the assignments, like there's a hanging man or a dead cat bounce, all these things kind of go to my first point. How do you define what that information just told you? Then in the mid 80s, a good friend of mine, Pete Stoudemire, started a program called the Market Profile. And what the Market Profile aimed at doing was basically saying, I can take any time series, I can arrange it whether graphically or again in a time series, and understand, as an economist named Gauss did 200 years ago, and create a bell curve. And if I create a bell curve and it's a quote normal curve, there's going to be a price at which you have the apex of the curve. And the logic was the more times the market trades at that price, the more important that price is. So it was a different way to look at the same data and now measure it in terms of price, time, and uniquely volume. So now you have a new dimension being added in volume, which I always thought was good, because we were, again, in the hedging business, we're always concerned the customer wants to execute a large trade. Will the market take that volume? And so that led to things today like VWAP, volume weighted average price. Most institutions will set an order with a VWAP requirement. It also now, with all the regulatory issues, and of course, not to get into things like icebergs and shadows or whatever. The other issue is the regulators said, we've got to make sure the customer is protected, that whether the volume is there or not, we can at least advise them and report that there has been a decent or a realistic fill. And so what's evolved from that is a process called TCA, or transaction cost analysis, which just basically says, tell me where the market was when you were putting the order in, tell me your fill, and then tell me where the market was after the fill. And that, that's kind of tongue-in-cheek way to say, did the market come up to meet your, you bought at the highest price or sold at the lowest. So all these things, over time have led to other, ways to not only look at data, but to monitor the markets. And it also just comes down to two things, kind of as we say here, and that is, what's the content and where's it come from? And in the traditional sense, really, you still have well over 90% of the market, from my estimation, that just trades on price. What's the market data? And there's plenty of great sources around. The data is so granular. It transports well. It goes right into algos. It's marvelous. The question is, how meaningful is it? And so what it led me to look at over time, and over here on the kind of in the margins somewhere, everyone starts to hear over the last 10 years, but more so the last 3 to 4, that social media has become really the more important metric of price. Mainly because if nothing else, there is so much more of it. And people don't really kind of stop to take a look at it. We've tried to get statistics on the number of, let's say, news stories of well-respected outlets like Refinitiv, the old Reuters, and Bloomberg put out a day. And that number is still somewhere under 10,000 stories, the best that we can estimate. What we can estimate is how many of those are repeat stories. So if Apple is putting out its earnings, or we just opened a store in India, for instance, is that story show up 5 times on each one, or whatever it might be. We then compare that to right now, there's at least 500 million tweets a day that mention a stock, a future, an ETF, a crypto, a fiat currency, literally anything in the financial world, you're going to find somewhere on social media. And so we've worked with a couple of great providers. We're working with Context Analytics right now, and they curate what we call the fire hose of social media. And then we take that data, and somewhat like we were doing, again, with the back office data, we normalize it, we aggregate it, And then we put our own algos to that. And hopefully the idea is that some of the domain experience of myself and my colleagues say, this is what I'd like to see. I want to know, what is happening with, let's say, the volume of tweets, just something simple, but at the instrument level. So I might get, for instance, a high score on the SFactor, and I'll show you that in a second. But if there were only 7 tweets on it, we're going to ignore that. It's just too spurless. So that hopefully is kind of a continuum of, and all these other processes obviously will continue to go on. At the end of our presentation here, we've put together what we call a confluence data set that uses social media and order flow data we extract from volumetric and NinjaTrader price feed, which is great, by the way.
That's great. And so, one question that I have, Jim, is when you talk about social media, are we talking exclusively Twitter, or are there other sources that
there's other sources in the feeds? There's a stock tweet feed. Reddit comes in. There's a few others.
Okay.
We like to start with Twitter because it's obviously the biggest, and then we're also able to kind of see what else is coming down the pipe, and we'll expand these as time goes on. But actually, it's also you really need to understand historically how they've looked. And Twitter is the richest from that perspective.
And so when we talk about, I'm just, because I worked at one of those companies you mentioned and worked with the people who are involved with their social media analysis.
Mm-hmm.
We often talked about being able to distinguish between a company being mentioned in a tweet for financial purposes, earnings, like you said, versus just you or I going to that store, that bank, that place and saying, oh, you know what? I had a great experience. I had a horrible experience. Does your service, or the source, I should say, not your service, does your source distinguish when they give you that feed? Is it something that you might be interested in? Like, overall, I just want to know every time this company, this index is mentioned, or filter out everything to a financial basis?
Mm-hmm. So our main flagship feed here is called the SFactor, and that starts around 9 o'clock Eastern time, and then it builds the next 24 hours based on that. And what we then take is this very granular data, but now because that's been circulating and there's about a little over 10,000 items in the database, you now have a baseline number. And so you do have the ability to go back. And I think to your point, is this a good number? Is it coming out? In other words, is there enough critical mass that you'd rely on the number? And we've always thought that was good, just if nothing else as a start. Second of all, it's standardized across the whole database. So we're not doing, something specific for futures, even though they may trade in a different pattern, or, we don't even try to get down to that level. Our job is to deliver the data. The second point is the sentiment scores have a good constant range of, in this case, let's say a +2 to a -2. So the real information yield we're looking for, everyone's looking for out of social media, is to find out that number. Is this a positive? Is it growing positive? Is it expanding? And then we take very standard kinds of, again, math, like 2 standard deviations. We can do a sigma, whatever the user wants to do. But we've now categorized everything from that we've taken out of the fire hose basically into a couple of big buckets. And so it's the pre-setup of that, that really makes it valuable data from our perspective. The next thing is that we then extend that with a bunch of different characteristics. So the idea there is we can look at, and I'll just show you kind of a quick update of that, where so we've got, let's say, the mean of that S score might be helpful. We like the volatility. There's the volume, way too tiny, if you will. This is a exchange traded fund summary data set. These are published daily and continuously updated all day. But you can sort for that in our environment very quickly and start to understand who's got volume and who doesn't. That's the other point. It may look good just as a couple of numbers coming across, a spreadsheet, or if it's on a tape. But if the information isn't there, in this case, the volume is too low, it's just discounted. The user can do what they want with our kind of motto is beauty's in the eye of the beholder. Again, we're delivering the content.
That's great. And that updates, like you said, that updates during the day. So you could have that up. If somebody subscribes to this data set, they could have it up, and it could essentially you're monitoring these markets that update with the new data and could sort, right? Adapt to
Right.
that data. Okay, that's really cool. Really neat.
And then just to kind of continue the other couple of things that we do, we provide a search engine with our data. So the next step is as I say, beauty's in the eye of the beholder. Our user can basically do any kind of deep dive on any of the data sets that are in metrics. And this tool really works exactly like you can Google your own database. The other nice thing about it, again, since this is all CSV/Excel, Google, it's a spreadsheet-based program. If you've got a program or data, I should say, that you'd want to upload, you can upload it here and then add our analytics to your data. So this helps with portfolio evaluation. In the case of my hedgers going back, we wish we'd have had this and be able to bring the data, directly to them. There's also a lot of different functionality within the search engine. So you can create your own pivot table with a couple of clicks. You can generate reports, you can share data. So the other point now is that we've made the data distributable, again, within our community. And again, the fact is these are updating continuously. You really don't have to do much once you log on. And then we also deliver the underlying spreadsheet. So if you just want to keep that and make your own histories, the flexibility here is pretty good.
And so I could create a report and share it with my broadcasting partner, Jim Cagnita, for instance. If there was something, he could pull up that report and see the latest data, assuming we had the service, right?
Yeah. Right. So I just said, give me a pivot table and let me see the S score for each ticker. And I did this in stocks. And this takes, like 3 clicks. Then I have it and I can share it, send it, whatever it might, that you may want to do. So the data is there. The tools are there. And again, the core point here is that how this interacts with any other decision support tool or approach that our user wants to take. It's a facility that's there continually, and it's really, designed to be about as easy as it can be. So if you'd like, I can move into the next, show you one of the data sets we're working on now, kind of back to what we were discussing of where social media data, in our view, is a lead indicator. But they're obviously, again, what do we do with that data? Well, we can look at it independently, as I've just done here. But what I've been doing, and our new kind of coming soon program, this is just about ready to publish, I'd say, in a week, is we've combined social media data with order flow information. A lot of people know it as the footprint chart, but we just take the word chart off the table. So here's the footprint data. And for those that don't follow footprint, these numbers are basically the actual volume in a contract. It can be done in stocks and futures. And it's based on market orders to buy and market orders to sell. And it's the logic there is that the participant that just wants to get a fill, get me in, get me out, that order takes precedence, and it's really a much better tenor, if you will, of what the market's information is telling you. So all market data basically becomes market generated information. It's then how do you use it? And in this example, what we've done is combine these two. So once we have this, now we've just probably nearly doubled the amount of information we are able to provide through metrics. We do these just because to keep the keep the computer from blowing up. There's so much data coming through. We take 1 minute samples, not samples. We take 1 minute observations, I should say. And for that minute period, and here's everybody's favorite S&P mini, for that period from 10:01 to 10:02, what was the open, high, low, close of that minute? What were the number of buys? What were the number of sells? Okay. Then we can start making some assumptions based on that. Then this is where our algos that are embedded can say, what's the probability that this is going up? What's the probability it's going down? And then where was resistance noted? So this is a very fast way, and our customers would keep this up. It's driven again continuously, and then you'll note down here we get to 10:10. So 10 minutes later, what the math has established is there's a bearish sentiment in the market. Very simple, but it's not as anecdotal as someone else saying here's support, here's resistance. It does all come out essentially to that point, but it's how we get there is a huge difference. And again, it's the combination of what else is social media saying about that. So how many tweets, for instance, would be about the S&P today? Those are plenty of volume, plenty of frequency, and then determining what it's really telling you to the point that if this is a decision support service, I'm ready to make a trade. So we've got data that we say is actionable, again, based on what the user wants to do. And then I just graphed that. So it's interesting and kind of proves the theory that if I look at the open, high, low, close, the same thing on that day, I'm looking down, from that level. And for quite a bit of time, you had, a downtrend. And then you start to see where these volume spikes. And again, this is based on the imbalances. Now we've got more buyers than sellers, or here we had, more sellers than buyers, or what you also had for all this kind of noise until you started to see these changes is basically a standoff. And what going back to Stottlemyre and really all technical analysis is trying to figure out if this is an all-day auction of this item and the auction's changing. We just want to know one thing, hopefully, to get down to the simplest. Who's in control? Is it the buyer? Is it the seller? Or is it changing? And so this kind of a graphic and all the data that's coming out, this again, we'll release this probably in the next few weeks.
Yeah, this is really interesting to me, Jim. I want to talk about that third panel real quick.
Yeah.
I understand the price activity. I understand the imbalance volume, but the sentiment, is that based on activity in social media and the price action, or is it based on the sentiment? Is there an evaluation of the content of the tweets?
Yeah,
or
if you look at the left there where you've got a 1.50, negative 0.5, negative 1, that's the range of positive negative. And in this particular example, it's intriguing that you didn't get much more than that. But it also says that the market doesn't have a level of volatility, as I read that, than if those numbers got up to, we've seen them up to 0.5, 0.6 in wild, crazy markets. So it acts as kind of another gauge that as I look at the data and I look at, the first, second, and third, and if you've had a range here, let's just put it in the context that the low, the S&P was around 4,000 at the high, let's say 40, right close to 40.50. Okay. So this is a 20-point move in the S&P mini. Okay. That's not in the scheme of things, all that big a move. That said, anyone who's trading still wants to know, I don't want to get bought up in here where you've got a lot going on, only to watch. It's interesting too, was this actually the timing? And these are on Eastern times, I'm assuming. So this is the first kind of negative push you've had since what, 11:30, and now it's 2:30. So you get used to understanding how to, first of all, just to visualize this, but it's also then when you see it, it's just, I think, a much better illustration. And to your point, how do I know what's really going on here? But our point is it's the confluence of these different items that the information yield of the combined data here is what's really appealing.
Yeah, it's interesting to watch these three charts when they align somewhat, whether it's two or three of the I would say peaks or valleys, right? They're not always going to align, but when I'm looking at that 2 o'clock mark, you've got price peak, you've got an imbalance volume peak, and then you've got this sentiment peak that kind of goes against those two, or not goes against, but it's kind of opposite what you would expect, but maybe not. Maybe there's a lot of imbalance up at the top, a lot of buyers here at the top, and then guess what? They weren't.
Well,
the market's changing.
Yeah, if you look at this one, okay, so you've got a big spike in the imbalance volume. Okay. And this is this is for illustration purposes. The actual numbers here could be much higher. But look what happened. You have a market that's basically now put in a new sideways here, but at a higher level, that's been trading, trading, trading. And look at these imbalances. They have one here, not so much. But what happens is it starts trending lower, and then you get another one. Then you start to see these, but these distances, okay, and I'm trying to extrapolate what the numbers would be, are lower in terms of the movement of the market. This isn't a big move.
Right.
So the other point that I want to make clear is it's the whole idea also, what we provide, our service is basically alerting you to these issues, that in this market, this is what's going on. So instead of looking at a chart, and not everybody is in front of their charts all day or can be, we've added another feature here, and I'll just move to it. This is kind of want to wrap up with this. So we take that same data and we push it out to our customers on a Telegram feed. And it's set up with, you can subscribe to just futures, you can do futures and stock, you can do all four, and then you can do and start to set up your own criteria and say, here's what I want, Telegram to, send me the message on. So when I look at this was set up for ETFs. I can scan for unusual volume. These are pretty ad hoc, and we're getting some great response on this. If anything, there's a lot of these that come out. So you have to be a little careful on what you ask for, as they say. Right. But the point is, you can take this on Telegram. We can send it to your phone. And what we want to work with is these will be the links can be available, through our NinjaTrader segment. We also will provide a hyperlink to these for Ninja users. So again, you might be looking at a market, but you may want to move over and say, okay, start pushing me these alerts. So it really adds to the potential that everybody has, and that is just, how do I get information and how do I want to digest it or store it, etc. So we try and make it as easy as possible.
Oh, that's really neat. And that's you're about to release that, or is that already there?
Yeah, and if you go to metrics.com, you'll notice there's a let's see if I can do that. I think I had it up here. Let me give me 1 second. I'll just bring up the website, I think.
Yeah, and by the way, everybody watching, Jim's company Metrics is part of the NinjaTrader ecosystem. So that's the nice thing. He's using NinjaTrader data and to power some of this data and integrate it with other data, and this is the result. So
if you just go to our website, it's a free trial. You can go right to Telegram, click on anyone that you want. If you click on the futures channel, you'll get that. Join the channel, or send me a note, jim@metrics.com, and we'll get you registered. And then you can, it's a free trial of the entire package.
Is there any other place, Jim, that people can find you? Do you have a social media presence, or is it all through the?
Well, we're on
the
Telegram.
website?
We do have pages on both Twitter and Instagram. We have LinkedIn. We have all that, but we've kind of held back on that because we want to get some feedback on the Telegram page, because it's just nothing against the other providers. It's just that it's much simpler for us to start pushing, and we want one happy customer, and then we go to the next happy customer and make sure we're doing that right. But those channels will all be up. They're all up now, but they're, the real data is here. We want people also that are using Metrics as it's designed to be a decision support service to, take a free account, and that opens up the search engine I mentioned and a few other items that are good to get it. Also, we do custom work. If there's something you don't see, let us know. With our team and external teams, we're able to deliver stuff pretty quickly and cost effectively. So you can design your spreadsheet, tell us the data. Obviously that opens the door to AI and some other good things coming along the pipe here. But our role is to deliver the data and make sure that the customer is getting what they want. This is part of how they make their living. So it's got to be, it's got to be working.
Right. Totally agree with that. Jim, we're right up against time. I think that, it's very, informative and interesting to talk with you. I'm sure we could talk more about this, because it seems like you're on the start of something that's going to just get bigger. And I hope all you viewers can go take a look at metrics.com and do what Jim said, take a look at kick the tires and hopefully you find value in that. Jim, I hope you have a safe trip back to Chicago.
I will. It starts in about 15 minutes. Thanks so much, everybody. I appreciate it.
All right. Thanks, Jim. And
Good.
thanks to our viewers. And we'll see you at bars closing later this afternoon. In the meantime, have a great trading day.
Great. Thanks, everyone.